Round and round she goes. When she stops rotating, nobody knows. Let's go. To see a week this ugly, you'd have to go back over a year. At this point, I'm sure many traders are saying, when will this end? But first, let's look at a heat map of the weekly. On this one, I see a tale of two cities. Essentially, we see tech here being sold off, and staples, utilities, and healthcare, essentially, they're getting bought up. Typically, this type of buying defensives indicates that we're more likely to be in some type of correction versus just a small pullback. As the MMs can't go into cash, they instead buy these defensives. I mean, let's face it, you're not going to rotate if the tape is moving higher. Now, interestingly enough, telecom did well, and also the large banks as well did well. And not the small banks, as when we look at the small caps later, you'll see that wasn't exactly a rosy picture either. So you may be asking yourself, what drove all of this? I'm sure it was a combination of a stretched market along with geopolitical concerns, and of course, Jerome Powell and friends. All of a sudden mentioning this week that likely no cuts may happen this year. If that's the case, the market has some repricing to do. When we flip over to the percentage of S&P 500 stocks trading above their 20-day simple moving average, is this tail candle telling us we're maybe ready for a short-term bounce? And the percentage of S&P 500 stocks trading above their 50-day simple moving average saw follow through, which means we're most likely going to head lower before we get ready to bounce. And that signals that this correction probably is far from complete. Looking at SPY weekly, the first thing that jumps out on the page is last week we talked about maybe coming through this 13 EMA and spiking it, but we went ahead and settled right on the 20 simple moving average. And at least for today, we didn't bounce at all. Now, going into next week's tech earnings, we have sold off quite a bit and are pretty much oversold. So will we go ahead and likely start to bounce here? And we'll go more into that in a bit. Now, bouncing here would be normal market behavior, but this epic run has been anything but normal since November. Okay, let's look at if we're in a corrective wave, which typically has an A wave down, a B wave higher, and then finishes with a C wave lower. So let's just say that currently we're in a first wave where we have a first wave down, a second wave higher, and then right now it's somewhere in the third wave. Now that we filled this gap on SPY daily, we'd like to see this maybe come up a little bit higher into a wave 4 and settle into a wave 5 that essentially is about the same size as this wave 1 to conclude our first A wave. Now I went ahead and I replaced that with our A wave on where we expect it to end. And now let's say this B wave, as it's corrective, it's going to want to at least come and retrace this dump 50% or even higher, let's say back into the golden pocket, which is a retrace of 65%, and it's going to spend at least a couple weeks doing that. Now, there are many types of corrective waves, but one that we see a lot on SPY is, we'll see like an A wave up, a B wave down, and then a C wave higher. Now, this corrective wave can be very difficult to trade. And honestly, many times I just stay out of trying to make some dough on these corrective waves. Usually I just find it easier to go ahead as we enter into this golden pocket area to start lining up my short trade to follow the C wave lower. Now, flipping back to the weekly, I went ahead and I added the fib extension so we could look at where we think this C wave will finally land. Well, typically this C wave will at least be the length of that first A wave, but there's always a chance it could be 62% longer. So, if we just go with the norm of this thing being an even wave, that means we land somewhere in the 480 area, and likely this takes us probably somewhere at least half the way, if not all the way through June. If you're finding all this helpful, then go ahead and subscribe, or even better yet, join the Discord, where I give traders what I'm thinking about before open and after close, as well as all my algorithm signals on over 70 equities with all my feedback on whether I'm entering them or staying on the sidelines, as algos can't account for everything. Looking at this MACD line, we see that it finally crossed the signal. And if we look at the not so recent past, we see here that there was a 10% correction here. This wasn't necessarily the best times to go long. And of course, when we saw this happen back here. Well, that was a year to remember back in 2022. And if we flip over to the Qs, if you watch last week's video, you'll see how I discussed how this was forming a pennant and the fact that this could be either bullish or bearish. And if it didn't go ahead and release this energy positively to the upside, that we were likely to go ahead and release it in the southern direction. And man, did we ever do that. But one thing to note here is that we broke right through that 20 simple moving average on the weekly like it wasn't there. So now are we likely to go down and retest this 50 exponential moving average? And it pretty much lines up with this 200 daily simple moving average. And of course, we've seen this selling now occurring on increased selling volume. Now, there are a ton of tech earnings on the docket next week that could bounce the tape, or will they behave like Netflix and just head lower on good revenue and EPS? To be fair, Netflix said they no longer were going to share subscriber numbers next year, but that's next year, not next month. Maybe even with a good report, it's time for traders to lock in profits. Now, after last week, I was really hoping that Russell would hold the support here, even though it closed below it, and bounce above it. Unfortunately, it just sunk lower and it's barely hanging on to this 50 exponential moving average, and this purple line is the 200 daily simple moving average. Let's face it, the Russell going lower in price this week on higher than average selling volume really took the brunt of the Fed saying, if we're lucky, we'll have one interest rate cut this year, as many of these stocks are interest rate sensitive, and so they were busy getting sold this week. And being that a lot of these companies are smaller companies that need to take out loans, being stuck at higher interest rates will not help them whatsoever. And being that smaller banks make up a large portion of this sector, I'm sure that as interest rates are staying higher for longer, this also could impact some of the smaller banks, causing them to go belly up. Now, next week, if we cannot hold this area of the 50 exponential moving average and the 200-day simple moving average, my guess is that we're likely to at least come down to this area, or maybe over the long term here, retest this bottom area of the range. And when we look at this MACD line, we see that it crossed below the signal. And in the past, when this has happened, this hasn't been exactly a signal to go long on with the Russell. As you can see, if we go ahead and point out a couple other areas, pretty much, we're seeing the same thing as well. The US 10Y yields continue to press higher. And of course, this is never good for equities. And you have to ask yourself, are we on our way to 5% once again? The VIX was up again this week, and this week it actually spiked above 20 and it closed above 18. Now that we're above the 18 area, of course, this makes swing trading a bit more difficult, as with higher volatility, you can get pushed out of either long or short trades quickly. And usually the higher VIX actually helps you do better with more like day trading than swing trading, as holding positions can be risky. Looking at the economic calendar, we see that Friday we're reporting PCE, which is probably the big news of the week. Now, one would think that with CPI and PPI already reporting for the month, that PCE should be a pretty much foregone conclusion, and a lot of this follows PPI, which wasn't actually that hot. If we pop up the earnings calendar, I'm just going to go ahead and pretty much highlight the whole thing, because there's just day after day, whether it's Tesla, Visa, Meta, Microsoft, Alphabet, Exxon, you name it, they're all reporting next week their earnings, and these will no doubt be moving the stock market in one direction or the next. Go ahead and check out my January video right here, where I predicted this year once we broke above the all-time high, and man, was I ever spot on. As that's all I have for now until the next video, and we'll see you then.